Imagine for a second that you are driving a high-speed train. You've got your hands firmly on the controls, you're monitoring the dials in front of you, and you are just hurtling forward at like 300 miles an hour.
Right. Sounds stressful already.
Yeah, but there is a massive catch. The tracks ahead of you, they aren't laid out in solid steel and concrete. They're actively being built and sometimes entirely dismantled via text messages from a conductor miles away, sent out in real time.
Oh, wow. So you have absolutely no warning.
Exactly. One message comes through and you have miles of smooth rail. The next message pings and suddenly a bridge is just completely gone.
Just gone. That's exactly what it feels like to navigate the global financial markets right now.
It really is. So welcome to this deep dive into issue number 009, the May 2026 edition of ACE 09 4U Market Pulse. Our overarching mission today is to completely decode a market where the dominant information channel has violently shifted.
Right. We're moving away from slow, predictable policy rollouts to bipolar, split-second social media posts.
Yeah, and it's a completely different game now.
It is a profound structural shift. We are not just looking at a highly volatile month in the markets. We are looking at a fundamentally new operating regime.
Right.
The latency between an event occurring or, even just the intent of an event being communicated and the market repricing that event is no longer measured in weeks or days.
It's minutes.
Exactly. It's measured in minutes. If you are sitting at your desk, still trading based on the assumption of a smooth policy gradient, you are essentially driving that high-speed train completely blindfolded.
Yeah, you're waiting for the newspaper to tell you the bridge is out, but the train has already plummeted.
Precisely. You're trading history, not the live market.
Which is terrifying if you don't have the right infrastructure. And honestly, to survive that kind of environment, you need the right tools, the right data, and frankly, the right legal and educational foundation underneath you.
You absolutely do.
So before we even get into the absolute chaos of April, I want to talk about how this ecosystem is maturing to meet that exact challenge. There are some massive updates from the ACE 09 4U universe this month.
Some really foundational stuff.
Yeah. First off, I am incredibly excited to share that ACE 09 4U is now an officially registered trademark of K&A Quant Holdings Ltd. In the United Kingdom.
That is a highly significant milestone, and it's worth pausing to explain why that actually matters to you as a listener.
Right, it's not just a fancy badge.
No, not at all. In the quantitative finance space, there is a distinct line between a community project and an institutional asset.
Oh, for sure. It's under UK Intellectual Property Office Certificate Number UK 0000433105. Yeah. And that's effective as of January 28, 2026.
Right.
So what this means for you, the reader and the listener, is that the name we operate under is no longer just a banner of intent. It is a registered asset of a UK incorporated company.
It carries true legal weight.
Exactly. It's the masthead matching the maturity of the content.
Yeah.
But the updates go way beyond just the legal structure. We really have to talk about the data because this is the lifeblood of everything we're going to discuss today.
It really is. The data is everything.
So break down the InnoTrader data server for us. Why is this such a big deal?
Well, it is perhaps the most critical infrastructural leap the ecosystem has made. For years, if you were an independent trader or, part of a smaller quantitative desk, there's been this ongoing dialogue about the inherent vulnerabilities of relying on rented data.
Rented data, right, like the typical retail broker feeds.
Exactly. When you rent data from third-party retail aggregators, you are inherently dependent on their uptime, their accuracy, and their latency.
So if there's a massive news event and their servers bottleneck, your algorithm is basically trading on yesterday's news.
Precisely. Or worse, you experience artificial spread manipulation and phantom ticks.
Ugh, the phantom ticks, the absolute worst.
Right. And those trigger your stop losses in ways the broader institutional market never actually experienced. It is a very fragile dependency.
Yeah, that makes sense.
The InnoTrader data server changes that equation entirely. It represents a philosophical and technological move from data dependency to absolute data sovereignty.
Okay, unpack data sovereignty for me. I mean, it sounds great on a brochure, but what does this actually look like under the hood? What are we physically looking at?
It means owning the pipeline from end to end. The data server is now live and fully completed for this quarter. It houses 21 meticulously selected instruments.
Wow, 21.
Yeah, we are talking about a deep cross-section of Forex, crypto, indices, metals, commodities, and energy. And it doesn't just hold daily closes.
Right.
It holds data across 9 different time frames, from the highly granular 1-minute chart all the way up to the monthly macro view.
And the historical depth on this is what really caught my eye in the magazine.
Oh, it's massive. It features a continuous, unbroken historical record beginning in January 2020.
Just think about what that window encapsulates.
I know, right? We are talking about the initial pandemic crash, the unprecedented monetary stimulus that followed, the aggressive rate hiking cycles of 2022 and 2023.
The return of structural inflation and massive geopolitical shifts.
Exactly. By having this pristine, gap-free history updated in real time through a top-tier institutional feed, we have the ultimate stress testing environment.
So it's basically the ultimate danger room for your trading models. You can throw the craziest market conditions of the last 6 years at your algorithm to see if it breaks.
That is a great way to frame it. This server is now the bedrock that proprietary tools like the AnyRadar, AnyBacktester, and the whole system run on.
Which means no more arbitrary gaps.
Exactly. By bypassing intermediary retail brokers entirely, we eliminate arbitrary data gaps. The algorithms are reacting to the absolute truth of the market at any given millisecond.
It's the difference between looking at a grainy, delayed photograph of the market versus a high-definition live feed. And speaking of foundational upgrades, there's also a major evolution in how the education side is being delivered. Anniversary is officially the next-generation learning management system.
It's a huge step forward for the community.
It's going to be the unified, long-term home for everything the brand produces. So the Legacy Mentorship's Level 1 with its bonus track and Level 2 alongside the flagship certified Quant Bootcamp, they're all migrating here.
It really streamlines the cognitive load for the student. When the educational delivery mechanism is frictionless, when you aren't hunting through a patchwork of old links and unorganized folders.
You can actually focus on learning.
Exactly. The focus remains entirely on absorbing the quantitative concepts.
Which you absolutely need to absorb if you want to use the next tool, because the community delivered something truly spectacular this month. We need to talk about the Elliott Wave Analyzer, or EWA.
Ah, yes, the EWA.
This was built by community members RevBins01, who architected the Wave counting engine, and Ozmel87, who contributed the institutional flow intelligence layer.
They did incredible work on this.
Now, I have to be honest. I have tried to study Elliott wave theory in the past. It is notoriously difficult.
It really is.
You look at a chart, you think you see a clear 5-wave impulse, and then you show it to another trader, and they tell you it's actually a complex ABC correction. It makes you want to pull your hair out.
Your frustration is incredibly common. Elliott Wave is traditionally a highly subjective discipline. The gap between understanding the theory in a textbook and executing it flawlessly while a live chart is aggressively moving right in front of you, that is where most traders fail.
Yeah, because human bias creeps in.
Precisely. You want the market to go up, so you subconsciously count the waves to support a bullish thesis. What the EWA does is completely automate that notoriously difficult task directly on a MetaTrader 5 chart.
Just does it for you.
Right. It identifies the current wave structure and provides a complete actionable trade setup. We're talking directional bias, a precise entry level, a logical stop loss, and 3 Fibonacci-derived profit targets.
But the best part, and the thing that completely blew my mind reading the issue, is the confidence system. It doesn't just throw out a signal and wish you luck.
No, it scores its own work.
Yes.
That is the crucial differentiator between a basic indicator and a professional analytical tool. The EWA uses a 5-component confidence score.
So what are the 5 components?
It looks at Elliott wave rule compliance, meaning, are the absolute unbreakable rules of the theory met? Then it checks Fibonacci alignment, oscillator agreement, wave alternation, and structural momentum.
That's a lot of confirmation.
It is. And if a setup doesn't score highly across all 5 of those individual metrics, the tool basically tells the trader, this wave count is ambiguous, step aside. It mathematically filters out the noise.
And it's structured in a way that scales with you. There are 3 tiers. You've got the standalone EWA, then a second tier that pairs it with AnyRadar for that premium intelligence feed.
Giving you context beyond just the raw wave counting.
Right. And the ultimate tier is the full bundle, combining EWA, AnyRadar, the Institutional Fund Flow Analyzer, and the multi-period analysis module. And the best part, nobody has to just take our word for it.
There's a demo, right?
Yes, there is a free, unlimited demonstration version running specifically on the XAUSD H4 timeframe. So you can literally just download it, apply it to gold on the 4-hour chart, and watch it do the math in real time.
Which is exactly the kind of transparency you need. Because, as we are about to discuss, the market we just lived through in April did not forgive ambiguity.
No, it certainly didn't.
The tools we just outlined are essential because the structural integrity of the market is being tested in completely unprecedented ways.
You know, watching algos get vaporized over a weekend makes you wonder who is actually in charge anymore. And I think that's the most fascinating part of this month's deep dive.
Definitely.
It's not just the tools you use, it's the sheer violence of the market they're operating in. Let's get into the main event, the core of issue 009. We are talking about the April whipsaw.
The big one.
The cover of the magazine calls it out perfectly. How one tweet erased 6 weeks of war premium and one strike put it back.
It was the ultimate test of the new regime. To truly understand the magnitude of what happened in April, we need to take a step back and look at the baseline setup going into the month.
Okay, set the scene for us.
Throughout March, the market had steadily, methodically priced in a massive supply shock signature. Geopolitical tensions centered around the Strait of Hormuz had built a significant, quantifiable war premium into the global energy complex.
Right, so everyone was operating under the assumption that oil supplies were going to be constrained for the foreseeable future.
Yes. And because of that assumption, cross-asset correlations had stabilized into a very clean, very recognizable pattern. If you looked at a terminal in late March, it made sense.
Stocks down, oil up.
Exactly. Equities were broadly down as input costs rose, bonds were down as inflation expectations heated up, commodities were obviously surging, and the dollar and gold were acting as mixed safe havens.
So the market had achieved a consensus view of the geopolitical risk.
It had. The quantitative models had adapted to this reality.
And then came the evening of April 8th. I remember exactly where I was.
Yeah, on the evening of April 8, a single social media post from the U.S. president was published. It announced a conditional ceasefire with Iran and the imminent negotiated reopening of the Strait of Hormuz.
And the sheer speed of the reaction is what still blows my mind. We are talking about a post hitting the wire just as New York was closing. And within 90 minutes,
Instantaneous.
the Dow added 1,000 points in after-hours trading. The S&P 500 erased a whole week of losses before the sun even came up.
The energy collapse was even more violent. Brent crude and West Texas Intermediate fell roughly 16.5% in a single session.
Wait, 16%? That's insane.
In one session. European equities, specifically the Stoxx 600, closed up nearly 4% the next morning. The travel and leisure sector in Europe, which obviously heavily relies on jet fuel and energy costs, jumped over 7%. That was the largest single-day sectoral move in 3 years. And the VIX, the volatility index, which had been camped out elevated above 30 for weeks, totally collapsed back into the low 20s.
90 minutes. Think about that. You go to grab a coffee, and by the time you sit back at your desk, a month and a half of global geopolitical pricing is just gone.
Vaporized.
6 weeks of deeply researched, carefully modeled war premium entirely vaporized in the time it takes to watch a movie.
And we have to connect this to the underlying market mechanics. Think about the massive quantitative systems running at major desks, the CTA's commodity trading advisors.
The algorithmic funds.
These are algorithmic, trend-following funds. Any model that had spent 6 weeks pricing a sustained energy regime change was instantly burned. These CTA systems had built up peak cycle long exposure in crude oil, long exposure in the US dollar, and short exposure in European equities.
So they were positioned perfectly for the March reality.
Exactly. Those systems were hit with the maximum directional book of the year heading right into that Wednesday session.
Wait, break that down for me. When you say they had a maximum directional book, you mean they were literally as heavily invested in that trend as their risk parameters allowed?
Exactly. They were all in on the war premium. So when that social media post hit, they had to aggressively exit on a single overnight gap. The positioning data on April 9 showed the largest one-session unwind of an energy-long, equity-short overlay since the Russia-Ukraine ceasefire false start back in June of 2022.
So if you were relying on human discretion, you might have hesitated. A human trader might have said, let's wait and see if this ceasefire actually holds before we sell everything. And maybe they would have lost less money.
Maybe.
But the systematic books, the automated models, they just blindly locked in the losses because their mathematical trend reversal logic triggered before the European cash open even started.
Precisely. The math dictated an immediate exit, regardless of the nuance, and this is where the cross-asset correlation story gets absolutely fascinating. For those 90 minutes on April 8th, The entire March regime completely collapsed. Stocks rallied, bonds rallied, commodities crashed, the dollar weakened, and gold sold off. Every major asset class moved in the exact opposite direction to its March signature simultaneously.
But wait, here's where it gets really, really interesting. Because the story doesn't end on April 8th. You finally recalibrate your models, you take your massive losses, your risk manager is screaming at you, you accept the new reality of a ceasefire, and then 5 days pass.
5 days later, on April 13th, the U.S.-Iran talks completely collapsed, and the U.S. Navy began active enforcement of an Iranian port blockade involving physical intercepts in the Arabian Sea.
Oh boy.
A second presidential post was issued. It contained just 3 words: active blockade enforcement.
3 words. And the entire complex just violently snaps back.
Violent is the right word.
Brent retraces from roughly $94, shoots back through $100 within 48 hours, and eventually prints near $126 by month end. Equities rendered half of that massive ceasefire rally inside of 3 sessions.
In quantitative finance, this is what we call the bipolar resolution function. The mechanical lesson of the April 13 reversal is actually far more important than the directional outcome itself.
How so?
Think about the trading desks that treated April 8 as a permanent structural regime change rather than a temporary headline test. They sized into ceasefire-aligned positions over the weekend of April 11 and 12.
So we went long European equities, short crude, short dollar.
Exactly. And by the close on April 13, those new positions had given back the entirety of the previous week's mark.
It's the classic whipsaw. You get chopped up on the way down, and then just when you think you figured it out, you get chopped up again on the way back up.
And here is the truly fascinating part. A major subset of the systematic universe, having just been burned by the false ceasefire signal on the 8th, actually undersized the blockade-driven rally on the 13th.
Yeah, scared.
They reduced their risk. As a result, they missed roughly 2/3 of the massive upside in crude through the back half of the month. That specific pattern, a false reversal, a violent snapback, and then under-participation in the snapback because the models are terrified, that is the textbook signature of a market where the information channel has become faster than the position management channel.
Okay, let me push back on this a little bit, or at least ask for some historical context, because if I am looking at historical shocks, say the Gulf War in 1990, the financial crisis in 2008, or even the initial Ukraine invasion in 2022, those felt different.
They were different.
The market crashed, sure, but it didn't feel like this manic coin flip. What has actually changed?
The underlying infrastructure of how information is disseminated and processed has changed. They were structurally different markets. In 1990, 2008, even 2014, geopolitical risk in energy markets was episodic. It was discrete.
Right.
A military operation began, prices repriced over several days, and then volatility slowly, predictably decayed over time. The information channel back then was highly institutional.
Official press releases and stuff.
Exactly. It was official wire reports, formal government press conferences, structured OPEC communique. The latency between an event happening in the real world and the price action fully reflecting it on a screen was measured in hours, sometimes days.
Right, there was a buffer, time for humans to digest and debate. But April 2026 destroyed that schema entirely.
They completely dismantled it. The primary information channel is now a single individual social media account. The latency between intent and intercept is measured in minutes.
Yeah.
The resolution function is no longer a tradable, mean-reverting process that a standard algorithm can model. It is literally a coin flip, and the face of the coin changes while it's still in the air.
So if I'm listening to this, and I'm a trader looking at my screens, how do you even manage risk in this environment? If the traditional 60-day rolling correlation models are dead because they rely on slow data, how does a trader even begin to size a position when the market acts like a manic pendulum?
It is the defining question of this era, and the answer is the core thesis of this month's deep dive. The trade is no longer the direction, the trade is the variance.
The variance.
Yes, you can no longer model the policy path as a smooth gradient between cut and hold or peace and war. If you are relying on a multi-asset framework that mathematically assumes 2 different asset classes won't deliver 3 sigma massive outlier moves in the exact same session.
Well, that foundational assumption was violated twice in 8 days in April.
Exactly.
So the volatility surface itself, the very way the market prices the likelihood of crazy moves, was completely mispriced.
Severely mispriced. Through March, Oil options desks were treating these headline-driven moves as left-tail events, meaning rare, highly unlikely anomalies. They were calibrating their mathematical weights to a multi-decade data set of comparable, slow-moving historical shocks.
Which didn't apply anymore.
Not at all. By the close of April 13th, it was blindingly obvious those weights were structurally wrong. The frequency of the shocks was higher, the magnitude of the moves was higher, and the decay parameter, how fast things calmed down, was lower.
Wow.
No static volatility surface can absorb a triple shift like that. If options desks didn't manually widen their headline risk pricing channels before that second post hit, they entered May holding a structurally underpriced book that was bleeding theta.
Basically, the price of every single asset in your portfolio is now a derivative of a single question, asked and answered multiple times per trading session, and the answer is decided by people who are definitely not reading your quantitative model.
It's sobering.
That is a terrifying but necessary reality check.
It necessitates a massive shift to automated headline ingestion. Firms that are still routing headline-driven orders through human portfolio managers waiting for a guy in a suit to read a post and click a button are bleeding alpha.
It's just too slow.
The speed of inference and execution has to mathematically match the speed of the new information channel.
Which perfectly illustrates why the tools we talked about at the beginning are so necessary. But here is where the story gets even deeper.
Oh, there's more.
Yeah, if social media is driving the minute-to-minute volatility, the sources also point out that the structural foundation beneath all of this is actively cracking. It's not just the information channel that's broken. The institutions we normally rely on to stabilize things are splintering in real time.
The global macroeconomic architecture is undergoing a profound historical stress test, yes.
Let's start with the Federal Reserve. The FOMC meeting on April 29. If you just read the top-line summary on the news, the headline looks incredibly boring. The Fed held rates at 3.50 to 3.75% for a fourth consecutive meeting. Nothing to see here, right?
Right, on the surface.
But if you look at the tape, it told a totally different story. It was an 8-4 dissent. That is the highest dissent count on a rate decision since October 1992. Now, explain to the listener why an 8-4 split is such an earthquake. Why does the Fed usually vote unanimously?
That is an excellent question. Traditionally, central banks operate on the principle of consensus. Even if members disagree behind closed doors, they generally present a unified front to the public to project stability and confidence in their policy path.
To keep the market calm?
Exactly. An 8-4 dissent vote structure is monumental because it shatters that illusion. It wasn't just a mild disagreement about the magnitude of a move. It was a fundamental, categorical disagreement representing entirely distinct theories of the current economic reality.
The reaction function of the central bank is visibly decomposed.
It has.
Let's break down the actual camps, because this is where the dual mandate of the Fed protecting jobs versus fighting inflation really clashes. You had Governor Stephen Miran on one side.
Yes. Governor Miran dissented in favor of an immediate 25 basis point cut. His logic was heavily rooted in the labor mandate. He argued that the labor market deterioration we saw documented through March warranted immediate easing, regardless of what was happening on the supply side inflation channel.
You just wanted to save jobs.
He essentially argued that the committee had no business signaling future cuts while energy channel inflation remained unresolved. He wanted action now to protect jobs before a recession hit.
But then you look at the other side of the dissent, and you have the complete polar opposite logic from three other regional presidents.
Exactly. You had Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan. They didn't want to cut. In fact, they opposed the easing bias language entirely.
They wanted to hike.
They wanted the language tightened to signal potential hikes. Kashkari, for instance, focused heavily on the regional cost of living signals. The overarching argument from this hawkish bloc was vehemently against building a majority theory based on supply shock conditionality.
So you have one group saying, the labor market is dying, we need to cut rates right now to save jobs, and another group saying, inflation is sticky, energy prices are out of control, we need to prepare to hike.
They are literally arguing about which variable is actually binding in a supply shock regime.
And because inflation right now is primarily supply-driven and energy import-driven, thanks to the Hormuz situation we just discussed, the reaction function of the Fed is no longer continuous.
No, it's categorical. Pricing models that treat the policy path as a smooth gradient from point A to point B are structurally wrong. The market realized this immediately.
What happened?
When the 8-4 descent was formally published, the probability of a June rate cut, which had been sitting comfortably near 30%, absolutely collapsed to near zero.
Wow.
The probability that the next move is actually a hike suddenly sat in the low double digits. The trade for quantitative desks is no longer predicting the level of the policy, it's trading the extreme variance around the path.
Which completely explains why gold, which is supposed to be the ultimate safe haven, sold off nearly 2% from its record level into the close that exact day. The market priced in a Federal Reserve that has formally institutionalized its inability to act with consensus.
Exactly.
And it wasn't just the Fed having an identity crisis. Across the Atlantic, the European Central Bank held its deposit rate at 2.0%. Christine Lagarde gave a press conference and described their situation as a layer cake of shocks.
It is a remarkably apt metaphor for Europe's current dilemma. The ECB is entirely trapped.
How so?
Well, at the bottom of the cake, you have stagnant Q1 GDP, which drastically weakens the case for maintaining a rate differential against the US dollar. But then on the next layer, you have the Hormuz disruption, which massively lifts the euro area energy import bill.
Right.
And on top of that, you have massive German fiscal stimulus that had supported the euro through January, but is now being overwhelmed by stagflationary headwinds. They are frozen in place by totally conflicting data streams.
But the institutional fracture isn't just with central banks. I think the biggest structural earthquake in the commodity space happened on April 28. The United Arab Emirates formally announced they're withdrawing from OPEC and OPEC, plus make effective May 1st, 2026.
This is a paradigm-shifting event. It effectively ends a decade in which global energy supply discipline could be reliably modeled as a single, coordinated input.
It's huge.
Energy macro models built on a unified cartel framework are now officially obsolete.
I want to push on this. The UAE is huge. Yes, they're the third largest member.
Yeah.
But don't the other members just absorb their quotas? Why does one public defector break the math for the entire global oil market?
It is a classic game theory problem. The cartel is now a partial coalition with a highly public, highly capitalized defector.
Okay.
The entire assumption of pricing power that underwrote a generation of term structure trades the belief that OPEC will always step in to put a floor under prices requires complete mathematical respecification.
They can't control the UAE anymore.
Exactly. If the UAE decides to pump at maximum capacity to capture market share, Saudi Arabia has a choice. Let them steal market share, or open their own taps and flood the market to punish them, which crashes the price.
Ah, I see.
Every quantitative model now has to encode discrete, highly variable scenarios for the May meetings and aggressively price the dispersion across the Gulf Cooperation Council sovereigns rather than treating them lazily as a single aggregate entity. The UAE's exit changes the fundamental baseline of global energy liquidity.
It honestly feels like the ground is shifting under every major institutional pillar all at once. Central banks can't agree, cartels are breaking apart, presidents are moving markets by 16% with a single post.
It's a lot to process.
And when the macro earthquake hits, it eventually trickles down to the micro foundation. Let's look at how these massive structural and informational shocks actually manifested on the charts for specific assets.
Looking at the micro fallout is where we see the actual mechanisms of wealth transfer during these shocks. The Forex market was highly illustrative of these changing regimes.
Looking at the top gainers, we saw the euro to yen, URJPY, up 4.25%. The pound to yen, GBP-JPY, up 3.80%. And on the flip side, the Swiss franc strengthened significantly, pushing USD-CHF down 3.50%.
Yes.
But the biggest story, the one that triggered a major study in the indie trader community, was USD-JPY.
Yes. The USD-JPY broke the critical, highly psychological 160 level. What is vital to note is that this break occurred specifically on the FOMC descent we just discussed, rather than on the ECB hold, which tells you a lot about market sequencing, what the market actually cares about.
Right.
But the core takeaway here is that the Japanese yen has fundamentally lost its historical safe haven function in a supply shock regime.
The interdetective angle on this was fascinating. The community used the InterTrader data server to study this exact 160 wall. Walk us through what they found.
What the Indidetective study revealed is that the four-way reaction function fragmentation at the Fed basically confirmed to the market that the Bank of Japan's immense patience would not be rewarded by Federal Reserve easing.
Oh, they were banking on a cut.
The BOJ was hoping the Fed would cut, which would naturally strengthen the yen. When the 8-4 descent happened, that hope died. So the massive leveraged short yen positioning that had briefly stabilized through early April was rebuilt aggressively into month end.
Even with Japan's finance minister giving direct verbal intervention warnings.
It didn't arrest the move. The market realizes the yen now trades purely as a mathematical rate differential expression. It is no longer a geopolitical safe haven. If oil goes up, the yen goes down because Japan imports all its energy. It's that simple now.
That's a huge paradigm shift. And if we pivot and look at the crypto market, we see that exact same bipolar action perfectly mirrored there as well.
Crypto remains highly directionally correlated to global risk sentiment at the cross-asset level, despite claims to the contrary.
Yeah, Bitcoin opened April near $74,000, surged up to $78,500 on that April 8th ceasefire news, and then flushed all the way down to $71,000 on the April 13 blockade reversal.
It was the bipolar resolution at the headline channel cadence, absorbing the geopolitical moves with massive amplification.
But underneath that Bitcoin action, the altcoin dispersion was absolutely insane. We saw SKY to USD up 549% for the month, NightHT to USD down 58%.
The altcoin dispersion is telling us something entirely new about the asset class. It is no longer driven solely by traditional narrative cycles or social media hype. It is increasingly being driven by structural legitimacy events.
Like what happened with Ethereum.
Exactly. The prime example in April was Ethereum, which outperformed Bitcoin by roughly 9%.
Right, and that outperformance wasn't just random volatility, that was pinned specifically to an event on April 17th.
Exactly. On April 17th, the Securities and Exchange Commission formally approved a New York Stock Exchange rule change, specifically SR NYSE 2026-17.
This rule allows for the direct tokenization of Russell 1000 constituents and major index ETFs directly on the NYSE order book.
Yes, this tokenization rule functioned as a massive structural liquidity and legitimacy signal for the smart contract layer of crypto. Layer 1 alternatives split sharply based on their actual utility in this new regulated institutional framework.
So it's about integration into the actual financial plumbing now, not just speculation on the white paper.
Precisely.
Speaking of plumbing, let's look at traditional equities because this is where the concept of liability overhang completely redefined single-name risk this month.
We noted earlier that institutional liability is no longer just about missing earnings estimates. It is being violently rewritten off the trading floor and into the courtrooms and regulatory dockets.
The examples in the deep dive are staggering. Look at Sportradar, ticker SRAD. It plunged 22% in a single session on April 22. It fell from nearly $17 all the way down to $13, erasing $800 million in market cap in a matter of hours.
And what's crucial is why it fell. It was the result of a coordinated short seller report from Muddy Waters and Callisto Research. But they didn't allege traditional accounting fraud.
What did they allege?
They alleged a highly complex regulatory theory. They claimed the company was actively aiding and abetting illegal online gambling operators, estimating that 20 to 40% of their revenue came from black and gray market clients.
And what is so crazy is that the market wasn't pricing the probability of the allegation being definitively correct in a court of law. It was pricing the probability of regulators simply acting on it. It converted the entire position into binary territory immediately.
Precisely. The credit complex moved right along with the equity. Credit default swaps on Sportradar widened sharply.
So the risk was everywhere.
The entire systematic equity desk now has to carry asymmetric tail risk weights for the regulated gambling complex. If a short seller can erase $1 billion of value based on a regulatory theory, your algorithmic models must price in that permanent tail risk.
And it wasn't just Sportradar facing this invisible legal hammer. Look at Bayer, down 6.5% intraday. And again, that wasn't an earnings miss or a failed drug trial. That was based purely on a split Supreme Court oral argument regarding the ongoing Roundup litigation.
The market listened to the justices speak and realized that the litigation overhang for Bayer is permanent rather than terminable.
Right.
Similarly, in the defense sector, the Hensley v. Florcourt Supreme Court decision significantly narrowed contractor immunity on the battlefield. That immediate legal reinterpretation compressed valuation multiples for the most exposed defense services contractors across the board.
So we're moving so fast.
The judicial dockets are creating massive, permanent, single-name dispersion. If you are building equity models that price tort and regulatory risk as static, unchanging historical loadings, you are mispricing the largest source of dispersion in the developed market complex today.
So if we take a breath and recap where we are, we've got macroeconomic models failing because the information channel is too fast. We've got central banks fracturing and losing consensus, cartels dissolving in public, and single-name equities plunging 20% based on court oral arguments.
It's a lot.
If you are a quantitative institution, how do you even physically adapt to this? When traditional models break, what do you do? That brings us to the changing infrastructure of trading, specifically sovereign tech.
When the operating regime shifts this violently, human intuition is no longer enough. The physical hardware and the technological infrastructure you employ become the absolute binding constraint on your survival.
Let's start with the government mandates, because this is a massive, multi-billion-dollar shift in capital. France's Interministerial Digital Directorate, known as DINUM, announced a massive directive on April 8. They are moving 2.5 million government workstations from Microsoft Windows entirely to Linux by autumn 2026.
This is what we call a sovereignty mandate becoming a massive procurement event.
Okay.
This isn't just an IT department deciding they like open source software better. It is about national digital destiny. Minister David Amiel explicitly framed it as a necessary step to regain sovereign control over their digital infrastructure.
Right.
The replacement stack relies heavily on European headquartered cloud and service providers.
Which means Microsoft loses a massive, sticky, recurring government contract revenue stream. And it introduces huge precedent risk if France does this. What's stopping Germany, the Netherlands, and the broader EU public sector from following suit?
Exactly.
Meanwhile, European cloud services like OVH Cloud and Scaleway gain structural, multi-year revenue runways.
For systematic equity desks, this completely changes the relative value pairs they trade. Shorting the U.S. tech megacaps that have heavy European government contract exposure and going long the European cloud beneficiaries becomes a highly viable, structurally supported strategy.
Wow.
The dispersion here is asymmetric, and crucially, this sovereignty push isn't happening in isolation. Connect France's move to the Anthropic Mythos meeting that happened on April 7th.
Right, the U.S. Treasury Secretary and the Fed chair actually convened the CEOs of the largest U.S. banks specifically to discuss cyber risk.
The context of that meeting is vital. Anthropic previewed a new, highly advanced AI model called Claude Mythos Preview. This model demonstrated unprecedented capabilities to identify zero-day vulnerabilities across major operating systems.
So flaws nobody knew existed.
Right. A zero-day vulnerability is a flaw in software that the creator doesn't even know about yet, meaning there is 0 days of protection against it. Corporate counsel across the entire financial sector are now logging this AI capability as a strict duty of care reference.
Meaning if a bank gets hacked, and they weren't using state-of-the-art AI defenses, they can be sued for negligence.
Exactly. The trade is no longer just directional cyber exposure. It is the dispersion between vendors inside that controlled release coalition who have access to the AI defense and those completely outside it.
It's all about access.
Yes. The regulatory risk of relying on outdated cybersecurity is now a measurable, tradable market factor.
Okay, so the regulatory landscape is demanding more robust tech. But what about the actual trading infrastructure itself? Because if the market moves in milliseconds based on a tweet, your server better be incredibly fast.
Speed is no longer a luxury for high-frequency firms. It is the fundamental requirement for basic risk management across all timeframes.
The sources highlight the Stack A2 audit. This is an industry-standard benchmark for hardware. They audited a Dell PowerEdge R770 AP server running the new Intel Xeon 6980P processors, and the numbers they found are wild.
The metric that matters here is the cold runtime for wrist engine repricing. Against prior reference systems, this new hardware stack delivered 9.6 times faster cold run times.
Okay, break down a cold run for me. I hear that thrown around by quants. But what does it actually mean for a server? Is that like having to reboot your entire GPS navigation system while you're already driving 100 miles an hour down the highway?
That is actually a fantastic analogy. Think back to the April 8 whipsaw. When a volatility regime shifts completely and unexpectedly when a tweet drops, your entire risk book has to be recalculated from a flat state. Oh, you aren't just incrementally updating a few minor variables. You are forcing your system to reevaluate the entire portfolio against a totally new set of baseline assumptions. That massive from-scratch recalculation is the cold run.
I see.
The speed at which you can perform that cold run is the absolute binding constraint on position management.
Because if your server is slow, you are flying blind while the market is moving against you by double-digit percentages.
Precisely. If it takes your system 10 minutes to recalculate your risk exposure and the market drops 16% in that 10 minutes, you are effectively insolvent before your screen even refreshes.
That's terrifying.
Upgrading to architecture that is 9.6 times faster is an internal capital allocation decision that makes your survival quantitatively defensible.
It's table stakes to even play the game now. And it's not just the hardware, it's how you access and process the data. BMLL Technologies just made their normalized historical Level 3 order book data natively available inside Databricks workspaces. For the listener who might only look at Level 1 or Level 2 data, why is Level 3 so important?
This is a massive operational lift for smaller quant teams. Level 1 data just gives you the best bid and ask. Level 2 gives you the depth of the book at various price levels. But Level 3 is the absolute granular truth.
The raw feed.
It is every single quote, every modification, and every cancellation across the full depth of the limit order book individually timestamped. Historically, analyzing Level 3 data required dedicated data engineering teams just to build the ingestion pipelines. It was prohibitively expensive.
But now it's integrated natively.
Yes. By integrating it natively into Databricks, the engineering hurdle is completely removed. Execution algo or Q analytics projects that were gated by data constraints can now move directly to the modeling stage. It massively compresses the cost of research.
And finally, in terms of tech shifts, there was a fascinating paper published on ArcVive regarding Polymarket and on-chain microstructure. We mentioned earlier that the focus here is the Trade FM tool, which is a foundation model that simulates the order book itself.
Yes, RSPAR 0.2604.24366. It analyzed prediction market implied probabilities for the Iran conflict resolution on April 8 and April 13. The crucial finding of this paper was that quantitative desks incorporating on-chain ground truth signals significantly outperformed those relying solely on the public WebSocket feeds provided by the exchanges.
It proved that the public feed was literally misreading direction in line with the paper's 59% finding. If you don't have direct access to the underlying truth of the blockchain, you are trading on a delayed, potentially inaccurate translation of the market.
It all ties perfectly back to the concept of data sovereignty we discussed at the very beginning with the NetTrader data server.
Yes, exactly.
Whether it is Forex ticks or on-chain prediction markets, or evaluating the Jane Street lawsuit regarding Terraform and UST Insider trading your signal and your legal defense, is only as good as the directness and purity of your data feed.
All right, we have covered a massive amount of ground today, from algorithmic whipsaws to institutional fractures to zero-day AI vulnerabilities. Let's bring it all back to you, the listener. How do we apply all of this right now? Let's talk about how the ASY94U community actually navigated this chaos in real time and look ahead to the May 2026 catalysts.
The real-time application of these concepts is where the theory meets the road. It is one thing to analyze a whipsaw in hindsight. It is another to trade it live.
Absolutely. And a huge shout out to a community member at RevBin01. His fundamental analysis system, the FAS, correctly delivered a risk-on diagnostic on April 27, right in the middle of all this energy shock and geopolitical fragility. While the rest of the market was panicking, his system stayed completely calm.
What's impressive is the methodology behind that calm. While the human headlines were intensely focused on conditional ceasefires and maritime blockades, the FAS system ruthlessly ignored the narrative and relied on its 5-signal framework. Specifically, it leveraged a liquidity composite index reading of plus 1.9.
It placed the regime in an adequate classification with a pro-risk bias.
Exactly. It ignored the noise and looked purely at the underlying liquidity plumbing of the market. High-yield credit was still outperforming long-duration bonds. Crypto liquidity scored a massive plus 4.7, and the systemic stress index came in elevated but not systemic at 41 out of 100.
That's incredible.
Because the system trusted the hard data over the terrifying narrative, it kept traders positioned optimally for the subsequent gains in the S&P 500 and the NASDAQ.
It's proof that a data-driven, scientifically backed approach works, even when the world feels utterly unpredictable. So looking ahead, what is the roadmap for May 2026? What are the catalysts that are going to test this new regime?
May is packed with structural catalysts that will determine if the violent April whipsaws stabilize into a workable second quarter regime or if we collapse into a third sequence of bipolar shock.
First up, May 1st. The UAE's exit from OPEC becomes fully operational.
This is the highest single-event volatility weight on the May calendar. The market is hyper-focused, watching to see if the cartel's residual 11 members can agree on quota reallocations to absorb the UAE's 3.2 million barrels a day.
Which is a lot of oil.
Do they hold the framework intact and absorb the gap as price weakness, or do they formally restructure the entire cartel? Saudi Arabia's diplomatic and production response is the critical secondary signal everyone is modeling.
Then on May 13, the SR-NYSE 2026-17 comment window officially closes.
This is the 30-day post-effectiveness comment window for the NYSE tokenization rule we discussed regarding Ethereum's outperformance. The structural read for systematic equity is that May is the implementation window in which the rail selection optimization surface first becomes tradable.
So we'll see it in action.
We will finally see how major prime brokers and custodians actually adapt to the dual rail settlement mechanics in practice.
And just 2 days later, May 15th, a literal changing of the guard at the Federal Reserve. Jerome Powell's chairmanship formally ends and Kevin Warsh transitions in, officially taking Mirren's vacated board seat.
While the dovish-hawkish balance doesn't materially shift based on the seat counts alone, the market's reading of the new chair's first public framing will be crucial. Remember the 8-4 dissent.
Yeah.
The market needs to see if Warsh can corral that fractured committee. His expected testimony during the late May Senate semi-annual cycle will completely reset the option term structure pricing heading into the critical June FOMC meeting.
And right in the middle of all this institutional drama, we get the mid-May, April CPI release.
Yes, the first full month of post-blockade price data. The energy pass-through component is the primary watch variable here.
Cool.
The market needs to see whether the sticky services component has begun to absorb the massive April energy shock through transportation and food logistics surcharges.
Right.
An inline print preserves the fragmented reaction function at the Fed. A downside surprise is a low probability outcome, but would carry massive immediate impact on rates and the dollar.
May is truly the regime under load. We tested it in April, and now we see if the bridges hold the weight of the train.
Which brings us to a final underlying reality that we need to address based on everything we've synthesized today.
Minus.
We spent a lot of time discussing the physical infrastructure of trading from 9.6x faster cold runs to France ripping out Windows for Linux. But if you connect the Anthropic Mythos AI capabilities to that government mandate, a chilling new reality emerges.
Oh.
If AI models can now instantly map zero-day vulnerabilities across global networks, the concept of a sovereign border is no longer geographical. It is strictly technological.
Wow.
The market isn't just pricing in earnings or geopolitical blockades anymore. It is silently pricing in which companies and which nations are operating inside the AI defense perimeter and which are sitting outside of it, utterly exposed. As a trader, you have to ask yourself, are your models capable of pricing the tail risk of a digital zero-day event, or are you still just looking at PE ratios and moving averages?
That is a phenomenal question to mull over. The tracks are being built and hacked right in front of the train, so you better make sure your instruments are calibrated to the actual risks of 2026. If you're realizing that your current tools aren't cutting it in this high-variance environment, there's a solution right in front of you. Download our magazine for free this issue and past issues at buy-this-wine-on-mag.com and state that the magazine is available on 3 languages on free and that it's a monthly release. In addition, a monthly podcast like this one discussing the magazine is published on our YouTube channel. If you are passionate about finance, follow our TikTok channel, NA Trader Hub. And finally, if you seek for a pro-grade community of traders to exchange idea with and to learn trading in a scientific approach based on data and not on dreams and imagination, you can visit our website, natrader.com, to learn more about us and how you can join our community.